Hello, everyone. Welcome to our weekly update. Got an interesting question this week about private credit. Let's go to, well, before I go to private credit, let's talk about the clay shoe coming up. Again, 13th year, we're raising money for multiple sclerosis. We raised a lot of money from a small event over these years. Hope you guys can make it. Uh, Call us or email us, we'll give you the details. Questions, we love the questions. Send them in ahead of time, gives us more chance to research, like this one that we got last week. First question. I read that private credit is risky and could cause another market decline like the mortgage crisis in 2009. What do we think? Well, the mortgage crisis led to the great financial collapse, and the banking industry had to get bailed out by the government, and the banking industry ended up with lots of controls on their capital and restrictions on their lending. What happened from that is private credit grew to fill that void that the banks couldn't do. Let's talk about what is private credit. Private credit is very simple. It's just not a bank loan. I can get together with five buddies, we can put a couple $1 million in an account, and we can go lend money to businesses. And we're not a bank. So we can lend money and we can choose our own rates. We don't have FDIC insurance. We don't have regulations under the banking rules that we have to follow. But this is not new. This has been going on for 40, 50 years. It just grew a lot in the last 30 years because the banks in the United States were under a lot of constraints. Now, the next question, and I'm going to show you a slide here, is this going to be a huge problem? This slide is the most important slide, and it says everything as far as I'm concerned. We have been users or investors in private credit for 8, 9 years. We've done publicly traded private credit instruments. We've done non-traded mutual funds in private credit. We've done direct investments in private credit. We're used to it. We're comfortable with it. And quite frankly, we think the returns are much higher than corporate bonds, and it has a place in a lot of people's portfolio. The problem with the great financial crisis and the mortgage loans was that the investment banks back then were allowed to invest in leverage up to 30 times. So if they had $1 million in mortgages, they could borrow another 30 million. Think about that for a second. If the mortgages start to default, and historically first mortgages had default rates less than 1%. During the financial crisis, they went as high as 5 and 6%. At 2% or 3%, you've wiped out your equity because you're so highly leveraged. Private credit is allowed to leverage 1-to-1. So if you got $1 million, you can borrow $1 million. This is not the same whatsoever. So if I've got $1 million of equity and I borrow $1 million, so I got $1 million in debt. Now, if I have default rates on the loans of 3, 4%, I still have a lot of equity left. So this is not the same. And quite frankly, the economy's been good. The US economy has been growing, and default rates have gone up slightly. They're around 2% in private credit. Historically, they've been under 2%. This will go higher if we have a recession. But again, this is nothing like the financial crisis. The other myth out there is that private credit is not transparent, there's no oversight, and you don't know what you're buying. This is just not true. We use publicly traded private credit companies and private ones. They're regulated. As mutual funds, they're regulated by the SEC. They have to put out quarterly reports. They have to show you their financials. They have to show you what they own. It is very transparent. So this is another myth out there that is not good for the industry. To give you an idea how private credit has performed over the last 20 plus years, let's look at some bad market periods. We'll go back to 2008. That was the mortgage crisis, the financial crisis. The stock market fell 37%. Leveraged loans, which is a different category, fell 29%. Private credit fell 6%. So it did well. In 2018, when the market fell 20% that year, by year end, the market was negative, private credit was up 8%. In 2022, the market was down 18%, private credit was positive. Now, this is important. We don't have the stat up there, but the bond market, the corporate investment grade bond market fell 13% that year. It was terrible. Private credit did much better. So the history of this, in our opinion, has been quite positive. And we continue to use private credit, and we will continue to use it for our clients. That doesn't mean you're not going to see some disaster stories. Just like anything, the stock market can go up and stocks can go down 90%, individual stocks. There are going to be some private credit disasters, which is why us and our firm and Raymond James do the due diligence and tend to work with the best established players. The other thing you should know is you shouldn't be buying this unless you're an accredited investor. And we think it's appropriate for accredited investors. If you want to talk to us about us, give us a call. You'll see here on the screen, basically a net worth of $1 million without your house qualifies you, or if you have a high income as an individual or couple. With that, we'll skip to the book of the month, 1929. For those of you, if you recognize this name, Andrew Ross Sorkin, he's on CNBC every day on Squawk Box. He wrote this book. I found it fascinating. It's really about 18 months, week by week, sometimes day by day, of what was happening during the 1929 crash. Very fascinating read, much different market today, much more leveraged, much less sophisticated, but definitely, in my opinion, worth your time. Thank you for joining us today. We hope to talk to you again soon.